Regular gold savings. Many people believe investing in gold requires large amounts of money, but history shows a different story. Imagine investing just $200 per month into gold consistently over time. This approach, known as dollar cost averaging, spreads purchases across different market conditions. Instead of trying to predict the perfect moment, you build a position gradually. This reduces the risk of buying at a peak and allows time to work in your favor. The strategy is simple, disciplined, and surprisingly powerful. Long-term results. If someone had followed this approach starting in 1985, today they would hold gold worth more than $320,000, more than the value of an average home in some regions. This is not the result of speculation or lucky timing. It is the result of consistency. Gold protected purchasing power across decades of inflation, economic crises, and currency changes. It didn't grow in a straight line, but over time, it accumulated value. Starting in 2000, even starting later, produces impressive results. If the same monthly investment began in 2000, the total value today would be around $140,000, nearly 3 times the amount invested. This demonstrates something important. Timing matters less than discipline. Markets rise and fall, but regular investment smooths volatility and builds resilience. Gold becomes not just a product, but a habit, a long-term financial routine, and over decades, routines often outperform predictions. Historical role of gold. Gold has never been just a financial asset. Throughout history, it has shaped empires, economies, and global power structures. Long before stock markets or digital currencies existed, gold financed wars, stabilized kingdoms, and symbolized authority. It was portable, universally recognized, and trusted across cultures. That made it the ultimate strategic resource. Even today, when financial systems are complex and digital, gold continues to hold that symbolic power, not just as money, but as influence. Alexander the Great. One of the clearest historical examples comes from Alexander the Great. After conquering Persia, he gained access to massive gold reserves. This wasn't just wealth, it was momentum. That gold funded military campaigns, supported logistics, and allowed expansion across continents. In practical terms, gold enabled strategy. Without it, sustaining such an empire would have been far more difficult. This moment shows how gold has always been tied to ambition, control, and geopolitical strength. Spain and inflation. Another story reveals a different lesson. In the 16th century, Spain imported enormous quantities of gold and silver from the Americas. At first, it seemed like limitless wealth, but the sudden increase in money supply triggered inflation across Europe. Prices rose, economies destabilized, and Spain eventually weakened despite its riches. The lesson is powerful. Gold can create strength, but it can also create imbalance if mismanaged. Wealth alone does not guarantee stability. Systems, discipline, and policy matter just as much. Government control of gold. Gold is not only tied to markets, it is deeply connected to politics. One of the most dramatic examples happened in 1933 in the United States. President Franklin D. Roosevelt issued policies that effectively forced citizens to sell their gold to the government. The goal was to stabilize the financial system during the Great Depression. Later, the government revalued gold at a higher price, strengthening national reserves. This moment showed that gold is not just private wealth, it is a strategic state asset. Impact on citizens. For ordinary people, the consequences were significant. They lost direct ownership of a resource that could protect against inflation and currency instability. Financial independence became more limited. Trust in government decisions became a central issue. The episode demonstrated how economic policy can directly affect personal wealth. It also revealed that gold is never purely neutral. It sits at the intersection of economics, law, and power. Lessons from history. The broader lesson is clear. Gold and authority are closely connected. Governments influence how gold is owned, traded, and valued. Economic decisions shape who controls resources and who bears the consequences. For investors and citizens, awareness matters. Understanding how policy interacts with gold helps people prepare for uncertainty. Gold is not just a metal. It is part of a system where finance and politics constantly interact. And history shows that those interactions can change the financial landscape overnight. Physical properties of gold. To understand why gold has held value for thousands of years, we need to look beyond finance and into physics. Gold is one of the most unique elements on Earth. It is the most malleable metal known. Just 1 gram can be stretched into a sheet covering nearly 1 square meter. It also has a distinct yellow color, unlike most metals, which appear gray or silver. This color is not accidental. It results from the way electrons behave under relativistic effects. In simple terms, gold looks different because of the laws of physics themselves. That uniqueness has always made it recognizable and desirable across civilizations. Durability and longevity. Another key characteristic is durability. Gold does not rust, corrode, or degrade like other metals. Almost all the gold ever mined in human history still exists in some form today: coins, bars, jewelry, or reserves. This makes gold incredibly suitable for long-term storage. It doesn't require special maintenance, and it can survive centuries without losing its structure. When investors talk about storing value, gold is a literal example of something that physically survives time. Gold supply limits. Now consider scarcity. Around 205,000 tons of gold have been mined globally. If melted into 1 cube, it would measure only about 22 meters on each side, surprisingly small for something that has powered global trade for centuries. Each year, mining adds only about 3,500 tons. Meanwhile, the global population and financial systems grow much faster. This imbalance between limited supply and expanding demand is one of the reasons gold retains value. Scarcity is not a marketing idea, it is a physical reality. Gold in modern finance. Today, gold is no longer the official foundation of global currencies, as it once was before 1971. But that does not mean it has lost importance. In fact, central banks around the world continue to accumulate gold reserves. Why? Because gold operates outside the credit system. It does not depend on promises, debt, or interest rates. During crises, financial, political, or economic, gold often becomes a stabilizing asset. It is not used for daily transactions, but it remains a strategic component of global finance. Expert opinions. Many analysts and institutions see continued strength in gold's role. Demand is rising globally, especially from central banks seeking diversification. Forecasts from financial experts suggest that gold could reach higher levels in the future, with some projecting prices approaching $4,000 per ounce. Whether those predictions come true or not, the trend is clear. Gold is still treated as a safe haven asset. It is not tied to a single country, currency, or system. That independence is its greatest strength. Conclusion: trust and value. In the end, the true value of gold cannot be reduced to a single number on a screen. Its price reflects inflation, psychology, trust, and history all at once. Gold is neither inherently expensive nor cheap. It depends on how stable the surrounding system feels. When confidence in money is strong, gold becomes quiet. When uncertainty rises, gold becomes important again. That is why it has remained relevant for centuries. It is not just metal. It is a universal store of trust, passed from generation to generation, and likely to remain so far into the future.